I'll be introducing Throughput Accounting Ratio or TPAR and explain the key concepts behind it. Throughput accounting is a management accounting technique that helps businesses make better decisions when resources are limited. It is based on the theory of constraints, which focuses on identifying and managing factors that limit companies' performance. The main idea behind throughput accounting is that every business has at least one constraint, also known as bottleneck. A bottleneck is any resource that restricts the organizations from producing and selling more products. Examples include limited machine hours, labor shortages, production capacity, or material availability. Unlike traditional accounting methods, which often focuses on reducing costs, throughput accounting focuses on maximizing the profit generated from constrained resources. It encourages managers to use bottleneck resources as efficiently as possible to increase profitability. An important concept in throughput accounting is throughput. Throughput refers to the money generated from sales after deducting direct material costs. In this approach, direct material costs are considered variable costs, while labor and overhead costs are generally treated as fixed costs in the short term. The objective of throughput accounting is to help organizations increase profit, improve operational efficiency, maximize throughput, and make better productions and pricing decisions. By focusing on the most limited resources, companies can identify which products contribute the most value and prioritize them accordingly. There is also a close relationship between throughput accounting and the theory of constraints. The process begins by identifying the bottleneck within the production system. Once identified, the company focuses on utilizing the bottleneck as efficiently as possible. This helps increase throughput and ultimately improves overall profitability. In summary, throughput accounting is a useful management tool that helps businesses maximize profits by focusing on constraints and improving the use of limited resources.
Thank you, Shuveythaa. I am Yamunna and I will now explain how to calculate TPAR and what the numbers mean. As you can see on this slide, TPAR is calculated by dividing throughput per bottleneck hour by factory operating cost per bottleneck hour. To understand this formula, let's first look at the two main components. First, on the left, we have throughput per bottleneck hour. This is calculated by dividing our throughput per unit by the bottleneck time per unit. Throughput per unit is simply the selling price minus the direct material cost. In throughput accounting, only direct material costs are treated as variable costs, while labor and overhead costs are treated as operating expenses. Next, on the right, we have factory operating costs per bottleneck hour. We calculate this by taking our total factory operating costs and dividing it by the total available bottleneck hours. Finally, we divide the throughput generated per bottleneck hour by the factory operating cost per bottleneck hour to obtain TPAR value. Now, let's look at a concrete step-by-step example. On the table above, we have a selling price of 500 ringgit, a direct material of 200 ringgit, and a bottleneck time requirement of 0.75 hours per unit. The total operating expenses are 12,000 ringgit per day, and available bottleneck time is 100 hours. To compute TPAR, first, we calculate the throughput per unit. We take selling price 500 ringgit minus direct material of 200 ringgit to get 300 ringgit. Second, we calculate the throughput per bottleneck hour. We divide 300 ringgit by 0.75 hours. This gives us 400 ringgit per hour. Third, we calculate the factory operating cost per bottleneck hour. We take total factory operating expenses of 12,000 ringgit and divide them by 100 available bottleneck hours. Finally, we calculate TPAR by dividing 400 ringgit by 120 ringgit. And we will get 3.33 as the final answer. Now, what does a TPAR of 3.33 actually mean? As shown in the table, if the TPAR is greater than 1, the product is considered profitable because it generates throughput faster than the company incurs operating costs. Therefore, management should prioritize producing that product. In our example, the TPAR is 3.33, which is well above 1. This suggests that the product is making good use of the bottleneck resource and is worth producing. Next, let's look at the product mix example below. Product B may seem more attractive at first glance because it has a higher throughput per unit of 300 ringgit compared to product A's 250 ringgit. However, product A only requires 0.5 hours of bottleneck time, while product B requires 1 hour. As a result, product A generates 500 ringgit per bottleneck hour compared to 300 ringgit per bottleneck hour for B. This gives product A a higher TPAR of 4.17 compared to product B's 2.50. Therefore, managers should prioritize product A as it makes more efficient use of the bottleneck resource. This shows that managers should focus on TPAR, not just throughput per unit.
Further discuss about TPAR, we have critically reviewed 5 journal articles related to the topic. I will be giving a brief explanation of each article followed by a breakdown of the common themes in them. The first article is Throughput Accounting, a Case Study by KM Anwarul Islam, published in 2015. The study investigates how throughput accounting can improve product mix decisions by concentrating on bottleneck resources rather than allocating overhead costs through traditional costing methods. The author concludes that throughput accounting helps organizations maximize profits and allocate scarce resources more effectively. However, the research is based mainly on one industrial case, so its findings may not be universally applicable. The second article is Lean Accounting and Throughput Accounting, an integrated approach by Tatiana Elsukova. This study argues that traditional management accounting systems cannot properly support modern production environments. The researcher proposes integrating lean accounting with throughput accounting, suggesting that the combination produces more useful information for managers. A major strength of this article is that it demonstrates how two modern accounting approaches can complement one another. However, the study is largely theoretical and lacks extensive real-world testing. The next article is Applying Modern Accounting Techniques in Complex Manufacturing by Mirelit and Olhager. Compares traditional costing, lean accounting, and throughput accounting within a manufacturing environment. The researchers found that throughput accounting provides better visibility of bottlenecks and operational constraints, allowing managers to make better production decisions. One advantage of this study is that it directly compares multiple accounting approaches. However, its findings are limited to a single case company. The fourth article is Using Throughput Accounting and Costing Methods in Making Short-Term Decisions by Abdul Rahman and Aziz. This research compares throughput accounting with conventional costing methods in a beverage manufacturing company. The results show that throughput accounting provides better information for short-term decision-making and helps increase throughput and profitability. However, the research only focuses on one specific industry, which is the beverage industry. Therefore, it cannot be applicable for many other industries. The final article is Throughput Accounting, an Overview and Framework by Parki, Tamrabarni and Punjabi. Rather than testing TPAR in a company, this study reviews existing literature and develops a framework for implementing throughput accounting. The researchers identify several barriers to adopting the throughput accounting system, which includes organizational resistance and lack of understanding among managers. While the framework itself is useful, it remains conceptual and requires a lot of further validation. After carefully reviewing all 5 articles, we have found several common themes. Firstly, The literature consistently suggests that throughput accounting and TPAR provide better decision-making information than traditional costing systems, particularly when resources are constrained. Secondly, many researchers recommend integrating TPAR with other accounting approaches rather than using it just on its own. Finally, although the theoretical support for TPAR is quite strong, there is still a lack of empirical or numerical research, especially within the Malaysian context. Overall, these studies indicate that TPAR is an effective tool for improving operational and short-term managerial decisions, but additionally, practical research and numerical research is needed to confirm its effectiveness across different industries and countries.
Now I'm going to explain about the advantages and disadvantages of throughput accounting ratio (TPAR). The main advantages of TPAR are that it focuses on the efficient use of constrained resources. Since bottlenecks limit the production capacity of a company, managers need to ensure that these resources are used in the most productive way possible. TPAR helps identify which products generate the highest return per hours of the bottleneck resource, allowing managers to prioritize those products. This leads to better utilization of available capacity and improved profitability. Another advantage is that TPAR supports effective decision making. When businesses have limited production time or resources, they often need to choose between different products. TPAR provides a clear and objective method for comparing products and deciding which one should receive priority. This helps managers allocate resources more effectively and maximize the overall throughput of the organization. Furthermore, TPAR encourages a focus on increasing profits rather than simply reducing costs. By concentrating on throughput generation, businesses can make decisions that improve overall financial performance. In addition, TPAR supports the principle of theory of constraint, which emphasizes the importance of managing bottlenecks and continuously improving organizational. Despite these advantages, TPAR also has several disadvantages. One disadvantage is that it assumes all operating costs are fixed in the short term, while only material costs are treated as variable. In reality, some operating costs may change with production levels, making the assumption less accurate. As a result, decisions based solely on TPAR may not always reflect actual business conditions. Another disadvantage is that TPAR relies heavily on accurate data. The calculation requires precise information about throughput, operating expenses, and bottleneck hours. If any of these figures are estimated incorrectly, the resulting TPAR may be misleading and lead to poor decisions. Furthermore, TPAR ignores qualitative factors. The ratio focuses mainly on quantitative measures such as throughput, cost, and bottleneck time, while non-financial factors are not taken into account. Important aspects such as customer satisfaction, product quality, employee model, and brand reputation cannot be measured through TPAR. As a result, a product with a high TPAR may appear attractive financially, but it may not necessarily contribute to the company's long-term success if these qualitative factors are negatively affected. Moreover, TPAR mainly focuses on short-term operational performance. It may overlook long-term strategic considerations such as customer relationships, market expansion, product quality, and innovation. A product with a lower TPAR might still be strategically important for the future success of the company. There are also several limitations associated with TPAR. First, TPAR ignores fixed and overhead costs when evaluating product performance. Since the focus is mainly on throughput and direct material costs, the impact of fixed costs may not be fully considered in decision making. As a result, a product that appears attractive based on TPAR may not necessarily contribute significantly to overall profitability. Second, TPAR tends to have a short-term bias. It is designed primarily for short-term operational decisions and may not adequately consider long-term business objectives such as market growth, innovation, or strategic investments. This can lead managers to prioritize immediate gains over future opportunities. Another limitation is that TPAR assumes there is sufficient demand for products produced using the bottleneck resources. In reality, customer demand may be limited, and producing more of a high TPAR product does not guarantee that all units can be sold. Therefore, market demand must also be considered when making decisions. Furthermore, TPR focus heavily on bottleneck resources and may ignore the efficiency of non-bottleneck operations. While improving bottleneck performance is important, inefficiencies in other areas of the production process can still affect the overall organizational performance and should not be overlooked. Last but not least, TPR is subject to market restraints. External factors such as competition, changes in customer preference, economic conditions, and market trends can influence sales and profitability. Even if a product has a favorable TPR, market conditions may prevent the business from achieving the expected results.
To conclude, Throughput accounting ratio is a useful management accounting tool that helps organizations maximize profits when resources are limited. Unlike traditional costing methods, TPAR focuses on throughput and the effective use of bottleneck resources. By identifying which products generate the highest return per bottleneck hour, managers can make better decisions regarding product mix, pricing, and resource allocation. Although TPAR has some limitations, such as its reliance on identifying bottlenecks accurately, it remains a practical tool for improving operational efficiency and profitability. Overall, TPAR helps businesses focus on what matters most, maximizing throughput from constrained resources and creating greater value for the organization. Thank you.